Okay, good morning, everyone. My name is Rachel Bubb. I'm a wealth manager here at KWB Wealth, and I'm going to be hosting the webinar today. So before we get started, just want to let everybody know that this is being recorded. We will be taking questions at the end of the presentation. So as always, please just type in your questions at the bottom of the screen. You'll see a Q&A box. So please type in your questions there. Please do not type anything into the chat. Unfortunately, we're not allowed to use the chat. We do have the poll right in front of you. If you please don't mind, take a second to answer the two questions on there, and we will answer those at the end. So before we get started, I do want to make a really great announcement. We have two new employees that we welcomed aboard recently. So Bella Figueroa, she is our front office assistant. She's the one that's answering all of our phones, making those appointments. So you guys will be hearing a lot from Bella. Then we also just hired an administrative assistant named Claire Olmstead. Just her right behind me, if anyone can see. She is also on the path to become a wealth manager. Today, we are doing the 2021 Mid-Year Economic Outlook. Again, thank you guys for all joining us this morning. Our speakers today are Robert Bullock and Quentin Bubb, Carrie Bubb and Diana Saylor, and Steve Gormley and Igor Nikichin. Sorry, Igor Nikichin. Today, we're going to be talking about three topics that our clients, you guys have all been asking us about, and then we'll hit some other smaller topics that we are getting questions about. But with that, we'll get started with our first topic, inflation. Quentin and Robert, why don't you start us off?
All right. Thank you, Rachel, for that introduction. Yeah, inflation, I think, is a good place to start because just a couple weeks ago, the numbers came out. June of 2021, inflation was at 5.4%. And that number is a rapid increase compared to what we've seen recently. It's certainly not the highest number we've seen in history, though. Looking at the chart that Rachel will pull up here in just a second, showing, inflation over the last few years has been relatively low, but, in the 1970s and whatnot, it was pretty high. And it is the highest we've seen since the Great Recession, which we actually in July of 2008 had it topped out at about 5.6%. It's not uncharted territory, but it is news now. And the reason, it's so high, there's a couple things to think about. One, it's a rolling calculation, meaning we're looking at June of 2020 to June of 2021. And when you think back about what you did in June of last year, we were in the midst of maybe the second shutdown, depending on where you lived and what county, state you were in, and prices had kind of fallen. We weren't driving into work, so energy prices had dropped because we weren't using fuel. The commercial buildings weren't up and running as much, so energy prices were lower because the usage was down. Clothing prices were down. All of that kind of stuff that we were doing, we kind of channeled our expenses, our spending in different ways, and prices actually saw a decline where inflation was actually at 0.6% in June of 2020. So that's one reason that the number is so high, is just of, kind of where we're at and what we were doing in the two time periods. But inflation is also caused by demand. And Bob, what are you seeing today as far as inflation?
Yeah, the 5.4% is quite a spike, especially if you compare that to the 2% inflation rate that the Fed's target is. And so I think near term, we got some imbalances when it comes to supply and demand. When the pandemic hit, so many of the manufacturers shut down their production. Consumers were still buying some, but when we came out of the pandemic, the consumers really ramped up their demand. And so there's not enough goods to go around. And so if you've got massive demand and not enough supply, that's a recipe called inflation. Prices go up. And so I think it's near term. The Fed says it's transitory. We'll see how transitory it really is. And we'll see how quickly the manufacturers can ramp up their production to clear out that supply imbalance. So that's the near term issues. Some longer term issues, it's going to be interesting. I think that it really comes down to wages when we look at inflation longer term. 60 to 70% of inflation really come down to wages. And so we've got some difficulty in the areas that were really hit hard by the pandemic. The restaurants trying to get their employees back. And the initial thought was maybe they're not being able to hire everybody back because of the extra unemployment benefits that those employees were receiving. If you can make more money staying home than going back to work, there's a good reason why they're having difficulty hiring. But I think that was the old idea. We've sort of come to a new conclusion that there may be something bigger going on. So many of us were working from home during the pandemic that I think a few of us came to the realization we really don't want to go back into the office. We like working from home. Or they may be a little bit older. They look at their KWB investment statements and they look good. If they're a baby boom age generation, maybe they're getting ready to retire, which is making the hiring problem even worse. And so inflation is a fear. It's not a reality at the moment. Quentin, check back with me in the first or second quarter of next year, and we'll see how bad inflation really is.
Yeah, and the other topic that a lot of people bring up to us about inflation is stagflation. And that is what kind of happened back in the 1970s, and whether or not we're in that kind of a period here. And I think there's a few things to think about with that. Right now, we have signs everywhere that, people are hiring, they're trying to get employees here just down the street. Some of the fast food chains, $15 an hour, and even signing bonuses at McDonald's. So it's a different environment than it was in the 1970s, where inflation was high, unemployment was high, because the messaging from the government was a little bit different, telling you, hey, don't go spend because then that'll bring down prices. Well, we don't spend money, people start losing jobs, unemployment goes up. The other thing is that prices were going up because labor unions could negotiate wages. We don't have as many labor unions as we did in the 70s. And technology. So technology is actually deflationary. It allows us to produce more goods and services at a lower cost. So we're not really in this era, that era where we had this slow growth, high unemployment, high inflation. Really, right now, what we're seeing is this rapid increase that at this point seems transitory, and that prices are rising. They'll probably, come back down. Used cars are up 45%. They're likely not going to stay up there. Lumber, maybe it will come down as well in the near future.
Yeah, one interesting statistic with lumber. What was it, a year ago? A ton of lumber was around $300 to $400. In May, less than a year later, it ran up to $1,700. That's almost a 400% increase. It's down, but I doubt it's going to get back down to where it was before the pandemic.
Yeah, so prices are likely going to go up, maybe level out a little bit, and then continue growing from there. So to some degree, it is transitory, but inflation is happening, and there's ways that we can invest in order to hedge against inflation. And Rachel, if you can bring up that chart, one of them is stocks. And then real fast, just this chart shows us the last 48 years, 24 of the highest inflation years and 24 of them being the lowest inflation years. And when we look at stocks, stocks actually perform really well in a high inflation period, because prices of goods and services go up, company earnings go up, and their stock prices go up. Typically what happens is companies don't take on inflation and the higher costs of goods. They actually pass it on to the consumer, much like maybe recently in the news you heard about Kimberly-Clark. The cost of toilet paper and manufacturing the materials for toilet paper have gone up. And now when you go to the store and you buy toilet paper, the cost is higher. So you can actually see that US stocks did pretty well in those 24 high inflation years, and they also did decent in the low inflation period. But there's other areas that Bob likes as well to hedge against inflation.
There are. This chart, as Quentin said, is 48 years, split up 24 years in the top box with low inflation years, which is 1994 through 2017. And during low inflation years, it is the financial assets. It's the stocks and bonds that do best. If you look at, once again, that top box during low inflation, large cap stocks are up 13.08%. If you strip out inflation, you netted about 10.8% for large company stocks. Not bad of a return. Bonds are up 4.7. And what does really bad during low inflation and low interest rates are all the way to the right? It's the commodities. The commodities that we know could be agriculture, the corn and the wheats, the metals, the gold and the silvers, the oil and the gas, which was the best performing group of the 1970s, probably not today. But I would also sort of highlight maybe the new commodities could be infrastructure. It could be solar, the wind and the water. But the commodities do terrible that we've seen near term. What's intriguing is if this inflation really is not transitory, and once again, we'll have a better idea, maybe the first quarter, first half of next year. We look at this bottom chart, the high inflation years from 1970 to 1993, all the way to the right, commodities were the best place to be. And so once again, we've got a fear of inflation that's not a reality. Included in the commodities, interesting enough, is real estate. If you look at the chart on both high inflation and low inflation, real estate was up 10.3% during low inflation years, and even during the inflation years of the 1970s, real estate held up well. So real estate seems to be an area that's done well in the past. As we always like to remind clients, what does well in the past may not do well in the future. And so, Carrie, you may have some comments regarding real estate and maybe some caution regarding it.
Yeah, thanks, Bob. So I think what we're saying is if inflation does come, and we're not 100% sure it's here and something yet to be worried about, real estate commodities might be something we want to pursue, but maybe not just yet. Maybe, like you said, let's talk next quarter, maybe beginning of 2022. So what we've seen in the real estate market is it inflation or is it price appreciation? If you're an investor, you love higher prices. So Diana, why don't you tell us a little bit about what's been going on in the housing market?
Absolutely. So we all know the housing market is a little crazy right now, but what we wanted to do is provide you with some statistics so you can understand what has happened. So this first chart we have shows the median home prices. So if you see last year in July, the median home price was $298,000. And this year it was $364,000. That's an increase of 22%. And it's up about 30% from 2019. In this next chart, we have seen actually at the end of June that over half of houses sold were sold above listing price. So that's almost 55%. And last year at this time, it was about 26%. And lastly, we've also seen that pending home sales are up 15% from last year. We are seeing a little bit of a downtick here, but that could go back up. But really the point is that it's pretty high from last year. So Carrie, why don't you give us some reasons or your thoughts about why we might be seeing this drastic increase in home prices?
Sure. So I think some degree it's like alignment of the stars have all lined up and everything is just perfect to create this kind of a real estate, I don't know if it's a bubble, but certainly rapidly rising prices. And the question is, how is it going to end? Is it going to end in a perfect storm, or is it just going to fade out and pause and whatnot? But I think the big thing is there's probably 6 factors. And when you look back, you got to start back in maybe 2004, 5, and 6. And when you saw all the new houses being built because of all the easy money, liar loans, stated income, which led to a really big boom. In fact, in 2004, 5, and 6, and 7, we were building almost 2.1 million new homes a year. Well, then we had the financial crisis, too much lending, too many people borrowed loans they couldn't afford, and prices plummeted in 08 and 09. In fact, they plummeted somewhere between 35 and 50%. So what happened then is builders stepped back. Look, we couldn't even build a house for the price that we could buy the house. So new home starts went from about 2 million down to about 500,000 in 2008, 9, and 10. And here more recently have just climbed up to about 950,000. So the big problem there is we've got a shortage. Over the last 7, 8, 9, 10 years, we have not built enough new homes to keep up, with the demand. And then I think the pandemic kind of created and accelerated, this problem. All of a sudden, people on both ends of the country that worked in the cities and lived in small places decided, wow, I need space, I need room. And what they began to do is question their quality of life. I want to live on more of an urban setting. Maybe I want to be in the country. Maybe I want to have a backyard, a home office. And so what that did is it created the demand for even more homes that the pandemic actually, I think, accelerated. And then you got the Federal Reserve and mortgage rates at historical lows. Here recently, we had people get 30-year mortgages, maybe at 2.8, 2.9%. And the Fed seems like no interest in raising rates anytime soon. So this low interest rates really helped affordability. And then you have these first-time home buyers that, it's called FOMO, fear of missing out. Boy, I'm watching these prices go up rapidly. The interest rates are real low. I need to hurry up and grab my piece of the real estate. And another thing that drove prices up, especially in the last year, is the cost of materials. Bob and Quentin mentioned lumber. Lumber went up, some 400% or 500% at the peak, adding about $36,000 to a new home. So builders had to raise their prices. Now that prices are actually falling, I bet you're not going to see they're lowering their prices though, because now they can get better margins. We'll see that in the future, how that goes. And I think the last thing is the millennials. The millennials were a little slow to do everything. They were slower to move out of the house, slower to get married. They tend to be more renters than home buyers. Hey, why buy it if I can rent it and not have all the responsibility? And now I think millennials are waking up and say, you know what, I want to start a family. I want something of my own. I don't just want to be a renter. And so all those 6 or 7 things have really helped drive those prices higher. And like I said, it's kind of an alignment of the stars, and how long this lasts, we'll talk about it.
Right, so it sounds like there's a variety of reasons, whether it's demographics or stemmed from the pandemic, as to why prices have increased so much. But I think the main question on everyone's mind is, are we going to have a housing recession? And, of course, we're not ready to call that, but, there's a variety of reasons why we think that it may not be a recession and that the demand could continue. So you mentioned earlier, the stated income, liar loans that we had back in the last housing recession. We don't have that now. Underwriting, rules and restrictions, and it's kind of hard to get a loan nowadays. And so what we're finding is, I read a statistic the other day that about 73% of buyers, their credit scores are over 760. And right now the loan to value is about 83%. So people can afford the houses that they're purchasing. So we're not really worried about foreclosures. And then also, you mentioned the Fed rates are probably going to stay low for the foreseeable future. But, those millennials or first-time home buyers, they know they kind of have a window of, hey, I need to buy this home, but maybe I'm not in a rush. And so they do know they have a time frame as far as interest rates going up, but maybe they're backing off right now. Maybe they're realizing, you know what, prices are just crazy. I'm going to wait 6 months or 12 months and see what happens. But that demand isn't gone. They're just waiting for the price mania to subside, and then they'll reengage. Sellers, there's a lot of people, over the next 6 to 12 months that they're seeing, oh my gosh, I can get this much for my house or whatever. So maybe, pending sales will increase. And then also, as you mentioned, home builders are ramping up. So there's evidence to suggest that demand is probably still there. But we do think that the rate in which home prices are increasing, that's just not sustainable. So maybe in the short term, we'll see, home prices come down. And, that's probably for the foreseeable future, short term. But Carrie, I mean, you've seen your share of housing recessions. What do you see for the long term?
Yeah, I got enough gray hair to see a couple of cycles there. These aren't just highlights. One thing that's interesting, Diana, is actually July 31st is the first time that we can start foreclosing, or that period ends. So a lot of people hadn't made their payments. And I think September 30th, I think, is when the forbearance stops, unless they were to reignite that. So there could be some people that are coming to the market that, because they didn't pay their loans the last year, the good news for them is they're probably going to be able to cover their loan and make a profit still. So they're not going to walk away like we saw in 2008 and 9. So a couple of observations, that I see. And I think the first one is boom and bust cycles happen. And it's not because of, a financial crisis necessarily. It's not because of the liar loans. There's lots of different reasons why people get excited about homes. It could be demographics, it could be low interest rates, it could be all kinds of different things, COVID. And so I think the point here is that, the next time the cycle goes south, which it will, it's going to correct. It just, we don't know when, and we don't know how severe, and it might just be a recession. The Federal Reserve raises interest rates trying to slow disinflation that may or may not come about. And as they raise rates, people, don't spend as much money, can't afford it. Then they lose their jobs. Now they can't make their mortgage payments, and the whole cycle starts over again. So boom and bust cycles happen for different reasons. And I'm sure when we get there, it'll be a surprise to us why this cycle ended. The other thing that happens is declines often beget more declines. In 1989 and at least in Southern California, prices peaked. From 1989 for 8 years, prices declined. And it wasn't until 2002, almost 13, 12 years later, that prices actually got back to where they were in 1989. In the crisis, 2008 and 9, prices actually fell for 5 years. So when they do start to go down, they don't usually just go down for 6 months or a year and then spike back up. Usually it's more of a longer term, drag out, kind of painful thing. And I think the other thing that's going to happen is this next cycle is going to be more synchronized. It used to be everything happened on the bookends, the East Coast and the West Coast, New York City, San Francisco, and all these cities on the coast would boom. And then all of a sudden something would happen and then they would bust. In the middle of the country, Arkansas, Iowa, they just kind of plodded along. They didn't participate in that boom and bust cycle. Well, this time they're participating in the boom cycle, right? People are leaving the cities because of small places, COVID, and they're going to Iowa and Idaho and different resorts in Wyoming and places like that. Prices going up dramatically. So the next time this cycle happens, my guess is it's going to be more across the board and not just as isolated to California or the East Coast or something like that. And for those of us in California, we know housing in California has been one of the most volatile places to be in the past. So what's a couple words of wisdom I guess I would have to you? And I would say this, that a home correction is likely. It's going to happen. The question is when and how severe. And it could just be the next recession actually triggers it. So if I was a landlord in single family housing, I would be careful. Don't go think you can just keep raising rents and prices are going to continue to go up. Again, I think the trend is still headed in a positive direction, but then at some point this is not sustainable. If you're a first-time home buyer, I would say to you, go buy the 10-year home. Don't think you can go out and buy your starter home and you're going to flip it in 2 or 3 years. You may very well get caught up in that volatile cycle, and all of a sudden, you're upside down and you don't have the equity. I think this next cycle, it's going to be interesting, and I think we're going to go from maybe homeowners and investors from fear of missing out to maybe fear of falling prices. So, definitely be careful out there. That's my advice. We talked about real estate and maybe there's a pullback. Well, the stock market is all-time highs. So maybe we jump over to Steve and Igor. Why don't you tell us about the stock market and some of your views, because we've all enjoyed, as I think Quentin or Bob said, the portfolios.
Sure. Thanks, Carrie and Diana. Yeah, Igor, I've been watching news feeds come across my desk, on Twitter. Goldman Sachs is predicting a 15% pullback. Merrill Lynch is predicting a 10% pullback. They never tell you when, but they like to say, yeah, here comes the pullback. The other one I saw recently was Harry Dent, famously, who said that in the 90s we were going to go to Dow 30,000 when he was pretty close, and then he's predicting an 80% pullback. That's more like a depression, but he said that 5 months ago, and it would happen in the next 3 months. So I don't really take a lot of stock into what he says, but I know that fear is out there. We have a lot of people reading the news, seeing that in the news, and then they come in to see their portfolio review, and they're seeing their 1-year returns 20%, 25%, 30%. They're seeing really great returns, and usually what goes up must come down. So I'm sure you're getting a lot of questions in review meetings about when is this pullback coming. So what are you talking about with our clients?
Absolutely. And like you mentioned, when people see their portfolios, over a 1-year period, they're up 20, 30%. Of course, people rationally think something's going to happen, something must go down. And building on the words of Carrie, it's not whether or not it happens, it's when and how severe. Do you know when to get in? Do you know when to get out of the market? And that's the kind of game that starts to become a little bit problematic to play. In fact, and Steve will talk more about this later, we can expect on average 10% or so a year for the markets to go down. So we can say that with confidence. We just don't know when. And in addition to that, there's not only timing the market, but there's a cost associated with it. In fact, we looked at the study and it looked at 20 years. If you missed just 2 weeks or 10 days, so 10 market days of the best performing days, which were typically after a recession or a market pullback, your returns over a 20-year period were cut in half. So that's a pretty big substantial change for trying to time the market. And people forget there is a cost associated with it. And lastly, like Quentin mentioned, you need some stock exposure to maintain levels with inflation. So you need to have that return That's what gives you all the return on a portfolio. It's the stocks. You don't get that nowadays from fixed interest rates or from bonds. You just don't get that kind of return. So people do need to have portfolios invested in stock, and they need to stay invested because long term, that's been the only proving strategy.
So are we just going to do nothing?
Well, not necessarily do nothing. Let me be clear. We don't advocate to time the market. That's something that is a recipe for disaster because all these other issues come from. However, there are things you can do that are proactive. If you have upcoming expenses, now may be a good time to take some money off the table and pay them now. Another suggestion that we typically have for our clients is maintain 3 to 6 months of emergency cash levels on hand. That helps you be able to ride out that volatility and sleep safer at night. Potentially even skip a distribution if you need it. And if you don't have that amount of cash on hand, and if you're still uncomfortable, use this time to replenish that bucket. That's another thing you could do. Not necessarily timing it, but planning around it. If you have that emergency cash, well, and if you're brave, then you can even call and buy on the pullbacks and get in at the market. Try to get into the market lows without getting out.
So that's things that clients can do. What could KWB do in the meantime if we saw something coming?
So we do keep an eye out for macroeconomic developments and events. However, we don't try to time the market again, because that's long-term. It's not had a great track record. Staying invested long-term has been the only proven strategy so far. So something we do is we make incremental changes. So not all or nothing, but going from 65% stocks to maybe 50% stocks based on macroeconomic developments. Again, not anticipation of the market going up or down. The other things we do throughout the year that kind of help reach that goal is we rebalance the portfolios. You know, if you have distributions coming out, well, we're selling something to get you that money. We're selling things that have done well already. So we're already taking part of that, capturing some of that growth that people have concerns is going to go back down. And in addition, some people, when they call, they want a dollar cost average. We do that too. So there's a lot of things that go on behind the background that we help you with and make sure the pullbacks aren't as volatile and you're in for the long run.
I know you have a background in psychology, behavioral psychology from your time at college. So what is that behavior? There is something going on inside of us that makes us want to, do something. So what is that? What is that inside of us?
Inner Freud. So of course, people feel strongly when the markets go down, and it's understandable. I mean, it doesn't take a lot of educational background to know that most people worked really hard to save up for their retirement, and it means a lot to them. I mean, it's their lifestyle, it's their legacy, and it's so much more. So seeing it fluctuate can be nerve-wracking. It could be distressful. However, people want to gain that feeling of control just by doing something. Doing anything is better than doing nothing. And so even though it might not be the wisest thing to do, people still tend to react and do something now because it feels good. So they want to get out of the market to regain that control, even though long-term they know it's not the smartest thing to do. We advocate get comfy, expect the pullback. We factor these things into our financial plan. If you looked at your financial plan, the growth rates we assume, they're not 8, 9, 10%, they're 4. So hopefully the returns are better, but if not, you'll still make it. So if you know that, then you can sleep safe at night.
Yeah, I know I've read about it in the past in our quarterly newsletter that, it's really, preparing for that pullback is just going to be more detrimental than the pullback itself. If you could go into a pullback, thinking about a pullback and expecting, maybe it'll go down 10, maybe it'll go down 15. Well, then you get down to 8, and then you get greedy and you say, maybe it'll go down another 2, and it shoots right back up. Or, it goes to 10, and then maybe it'll go down to 15, and then you never get back in, and it goes right back up. So it's one of those things that timing the pullback is really not that, it's not something we can do. So what can we do to show you how we would react, or how the market reacts when these things happen? So Rachel, if you could bring up the first chart I have, you can see here that over the last 41 years, the gray bars is showing you the returns that you were getting in the market in the S&P 500 over that time. And the little red dots are showing you the pullbacks that we had in every single year. And if you average those pullbacks out we had a pullback of about 14.3% per year. Now, we have some years where that's a lot higher. In 2008, we had the 49% pullback, and we had many years when it was a lot lower, less than 10%. But over that 41-year time frame, you still returned 9% annually. So if we had a little mountain chart going along, it would steadily increase. We would have some dips, but over that long period of time, we definitely had a really good growth profile for stocks. Now, if you bring up the next chart, what it really comes down to is your time frame. If you're investing in stocks, your time frame should not be 1 year. Your time frame should be 5, 10, even 20 years if you're investing in stocks. You can see from this chart, this goes back 70 years, and it's a rolling return for stocks, bonds, and a 50-50 portfolio. In 1 year, that stocks in that green bar could be up 47% or down 39%. Now, if you extend your time frame out to 10 years, now you're looking at a return of up 19 or maybe down 1. So a lot less volatility over a long period of time. Most of our clients live in that gray bar. And so you can see that you might expect from a 50-50 allocation, 50% stocks, 50% bonds, maybe you're going to be down 15% in 1 year. But even if you extend your time frame out to just 5 years, now you're looking at, it's up 21%, or even at the worst, you were up 1%. So it really comes down to how are you invested? What is your time frame? And if you're investing solely in stocks, your time frame needs to be a lot longer than this 5% or 10% pullback. The last thing I'll say is that when we're dealing with pullbacks, it's always that control that you really want to have, but it really comes down to how can you sleep better at night? And let's look back to March of 2020. If you went into March of 2020 and the market's falling 35% in about 3 weeks, and if you lived through that and you said, KWB is taking care of me, I know that they're looking out for my best interest, they're going to be selling bonds in this time frame, not going to be selling my stocks, and we're just going to ride this out, then you're probably right on where you need to be from a risk perspective in your allocation. You have just the right amount of stocks, right amount of bonds, you're good to go. But if you are in that time frame calling us up, market's down 5%, market's down 6% the next day, and you are freaking out, that is a time when, it's not the time to assess during that time. Let's wait for the market to go back up. But maybe after that time frame, you really need to assess, do I have the right amount of stocks? Maybe I need to pull back my risk a little bit in my portfolio.
Sounds great, Steve and Igor. And what I want to do here is kind of go into like a lightning round or some of the questions we've been getting asked by clients. So we're talking about rising prices and real estate appreciation. We've also heard about rising interest rates, and that's one of the ways the Fed deals with inflation. So Diana, why don't you tell us a little bit about rising rates and what we need to be thinking about?
Sure. So rising rates, we've been hearing that a lot over the last several years, and rates currently are actually below where they were pre-pandemic levels. And we've seen quite a bit of fluctuations with interest rates. It's been really interesting. We were just talking about the other day how well the long-term treasuries have done. And so what we saw earlier this year is interest rates actually went up some. And I think what we were seeing there is we might see, or I guess understand that a lot of investors or institutions had fear of missing out. You look at stocks and how well they were doing, and maybe they got out of bonds and went to stocks. And then also interest rates just recently went down. So I think there was maybe some, thought that the economy may not be recovering as well as they thought. So it's kind of been all over the place. Our thought would be is the interest rates or the Fed funds rate is probably going to be within a range pretty low for the foreseeable next few years. The Fed hasn't talked about raising rates till late 2022 or 2023. And like Bob and Quentin talked about earlier, it kind of depends on inflation. Is this transitory? Are we going to see rampant inflation? And so that obviously has, an impact on that. But when the Fed does decide to raise rates, it's probably not going to be a point or two at a time. Maybe it'll be incremental. So really, we think in the short term, rates are probably going to remain relatively low.
Yeah, and I remember over the last 5, 6, 7 years here thinking rates are going to rise, and guess what? They never rose. And, we had COVID and rates coming down, 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 down. So, the common wisdom isn't always right. So, we're talking about rates going up. We've also heard a lot about taxes going up and some of the proposals maybe that Biden has had. So, Bob, why don't you tell us a little bit about what you see on the tax front?
Carrie, bad news sells. And so what we've seen headlines of massive tax increases, both on the income side for individuals and potentially for corporations as well. But I think the headlines is to grab the opposition party's attention in order to start negotiating something. And so the phone calls that the advisors at KWB have been receiving from clients of, oh my goodness, should I sell my investments? Should I sell my real estate in order to capture today's tax rates as opposed to potential higher tax rates? We've told clients, I wouldn't do anything at this point. It's only proposals. There's no reality to what's being proposed at this point, whether it's individual income taxes going from 37 to 39.5, whether it's corporate income taxes going from the current 21% to maybe 26 to 28%, with the potential of a global minimum tax is 15%. A lot of proposals, a lot to discuss between the politicians, but there's no reality to it at this point. I'd leave things alone. We'll continue to monitor it. If something comes up that we think that our clients will know, we'll be in touch with our clients to tell them some strategies and options to give them. But it's a worry, but no reality at this point, Carrie.
Right. Yeah, and I think getting that majority and even trying to pass that infrastructure bill at 2.9 trillion has been way watered down to $1 trillion, and I still think it's struggling there. So I've also had a lot of calls about cryptocurrencies and what's going on there in the marketplace, and should I participate in these things like Dogecoin and of course Bitcoin, because here recently Tesla and even El Salvador talked about accepting cryptocurrencies. So Steve, why don't you shed a little bit light on cryptocurrencies and what we think and a little bit of background?
Sure. Yeah. So let's start with a little bit of history. Bitcoin was started by the founder. He was really frustrated because he was moving from the UK to the United States, and it took him over a week to transfer his money and to transfer his cash to dollars. So what he wanted to do was create a digital currency, something that he could take with him wherever he went around the world. And, to really disrupt paper currencies or the banks, they would really, this Bitcoin or the blockchain technology that is the backbone of Bitcoin would really need to process a lot of transactions, just like a bank or just like a credit card would. So right now, credit cards or banks can process about 150,000 transactions per second. And right now, the Bitcoin blockchain can process about 7 transactions per second. So a lot fewer. So next, what would really disrupt our traditional currency would be price stability. And the reason you need price stability is because if I'm going to trade my dollars for a good, or if I'm going to trade my Bitcoin for a good, well, I need to know that the price is not going to fluctuate drastically, because if I, bought a pizza today and then the price of my Bitcoin that I paid for that pizza went up 10% or 20% the next day, I would feel really bad about buying that pizza. So we don't really have that price stability either, as you can see from the market Bitcoin going from 60,000 a few months ago down to 30,000 and then up to 38,000 today. So the use case has really shifted from being, okay, this is a new digital currency, to being a store of value or a digital gold, something that can beat inflation over time. Well, that might be true. I mean, a cryptocurrency could beat inflation over time, but what are you really investing in if you're buying a cryptocurrency? There's no earnings, there's no dividends that a cryptocurrency is throwing off. So really what you're wanting is the next person to pay more than you paid for that thing. And what that is called in investing is the greater fool theory of investing. You think that there will be someone else out there who's willing to pay more than you were for that good or for that investment. And so what we would say at this point is, if you really want to speculate, if you have some extra cash lying around that's non-trivial to your plan long term, then that's okay. You can speculate with that fund, with those funds. But for us as fiduciaries, we would not recommend it as an investment at this time.
Yeah. And I think it's important to remember we sometimes worry about, the dollar, and at least the dollar is backed by the full faith and credit of the U.S. government. Now, you could argue they own trillions and trillions in dollars, and what is that word worth? But when it comes to Bitcoin, that guy that founded it, he's not backing up anything. There's nothing behind Bitcoin except the hope and the prayer that somebody else will pay something. No full in faith, no credit, no obligations, no assets, no earnings, no nothing. So definitely a speculative thing, but it's working. At least it seems to be working for some. So as Steve said, as a fiduciary, hard for us to encourage people to do that. I don't personally participate in that. And, maybe at some time I wish I had, but I'd rather be safe than sorry. I've been sorry before. So Rachel, we've kind of covered everything here for the questions and the lightning round, whatnot. I think we were going to open it up to questions, but before you do, I'm dying to hear about these poll results. Let's see if the people got the answers right.
Yes, so I'm going to go ahead and pull up the poll results.
Thing is that first one is 64% think this is not a good time to purchase a home. And that's kind of falling with what the news media is. It's probably a great time to sell before the buyers kind of wake up to this. But yeah, purchasing a home, it's probably time to be cautious. And a lot of people didn't get the bottom one. What has been the biggest contributor to inflation? It's been used cars. I think, Steve, you mentioned used cars prices are up over 45%. Crazy. Some people even paying more for a used car than it was when it was brand new. So kind of an interesting periods of time. So let's close that out, Rachel, and then let's open it up for questions. I see maybe there's one out there.
Yes, so we have one question. In the 1989, when home prices went down, what happened to the interest rates?
In 1989, interest rates were probably in the 6 to 7% range. I don't think interest rates really changed much at that point in time. In 1989, that kind of cycle was more about overbuilding in 88 and 87. And then it was more geographical. It wasn't a cycle that happened across America. It was predominantly here in California, overbuilding. And I have to go back to see if it was interest rate driven. I don't believe it was. In 1990, remember, we had the first Gulf War. We kind of had a mild recession. People were losing their jobs. It wasn't, it was George Bush Sr. was the president. We kind of had a hiccup there with that whole American was invading, I think, Kuwait and protecting it. So again, more geographical that time, not synchronized, across the country, like maybe what we're suggesting maybe the next downturn could be. Anything else, Rachel?
No, that was our only question that we had for today.
Okay. Well, we either did a thorough job of explaining everything and answered every question that possibly could be on somebody's mind, but we certainly thank everybody for tuning in, and we appreciate your continued confidence. Feel free to email the advisors or anybody at the office, or call in if you have any questions. And Rachel, did you have any other closing remarks?
Yes, so this webinar will be available for replay. So if anyone missed it or you would like to share with a friend, we'll be emailing it out to everyone probably at the earliest of next week. And with that, that's all I have. So thank you everyone for attending. We really appreciate it, and stay tuned. We will have another one in January, as always. So January and July are when we do these things, and we look forward to seeing you guys again.
Thank you.
Bye.